Check, check. Chalo. Now, my dear students, last concept, last session. Online students, you guys are there with me? Yes, sir, no, sir. Yes, last session. Start with capital. Gain your and very conceptual. What are we going to? We have learned that we can of right. We can also select a particular plan on the basis of what MPS. But now, how to calculate cost of? In this cost of capital chapter, learn how to calculate the effective. Learn beta how to calculate effective cost. Guys, what do I mean by the word effective cost? Effective cost means tax cost or after tax simple. Then the answer is always after tax simple. Now see, have 10% debt, whether you buy 10% preferential or you want 10%. What should you percent? Very simple. Have 10 raise 10 lakh rupees. On 10 lakh rupees, 10%, how much is the amount of preference dividend you have to pay? And here also there is an option either to raise debt or 10%. How much is the interest? What should you prefer? Prefer preference share, debt. Prefer debt. Why? Because debt you have to pay interest. This lead to dash tax save. Whenever I basic word cost, actually your effective, that is cost after considering tax impact. Now, my dear students, capital chapter we are going to be the effective cost is always divided by alpha. Calculate cost of debt. We are talking calculation of KD, and the formula for KD should press into 1 minus upon what net proceed. Now I will have to consider tax interest cost, or I should consider tax interest, post tax interest, right? Now, why do I tell you that we should consider post tax interest? Let's say, for example, your Jeep brought down 5 lakh rupees. Tell me in preference share, when we are paying preference, can we pay first preference, then tax? Pay tax and then preference. First pay tax and then we have to pay preference, right? Suppose your tax rate is 30%. can I say on this 5 lakhs, I will have to first pay the tax profits of 5 lakh rupees. And on 5 lakhs, suppose there are no other expenses. On 5 lakhs, I will pay the tax at the rate of 30%. So how much tax am I going to pay? 5 lakh into 30%. Can I say 1,50,000 tax I have to pay? But if my GP 5 lakh and if I'm paying interest of rupees 1 lakh, then can I say I will be left with a profit of how much beta? 4. On 4 lakhs I have to pay 30% tax, that is nothing but 1,20,000. Can you just check that because of interest, are we paying lesser amount of? So what is the lesser amount of tax which I am paying? If I would have not paid interest, then I would have paid 1,50,000 as your interest cost, as your tax. From this, if I subtract 1,20,000, then can I say because of interest time I am saving tax of 30,000 rupees? Come on, yes or no? Yes, sir. So when you want to give 1 lakh rupees by the way of your cost, don't you think you are giving 1 lakh rupees cost in a way that it tax savings? Yes or no? Yes, sir. So what is the net effective cost if I am paying? Can I say 1 lakh rupees is the interest cost which I am paying and 30,000 tax am I saving? So in that particular case, my net cost is how much beta? 70,000. This 70,000 can I also calculate by taking interest into 1 minus tax rate on yes or no? Yes, sir. What's my tax rate, boss? 30%. So on the interest of 1 lakh, if I multiply it by 0.7, can I say 70,000 is my net interest cost, which is after tax implications? Come on, yes or no? Yes, sir. So always remember that whenever you are calculating KD, how will you calculate KD beta? Interest into 1 minus tax on net proceeds. Now debentures can be issued either at par, at premium, at discount. Now if suppose my debentures are issued at some premium, then don't you think that I will receive more than 10 lakh rupees by the way of my net proceeds on yes or no? Yes, sir. If I issue at a discount, then I'll be receiving less. Sometimes they will give you the net proceeds amount readily available. Or sometimes, my dear students, they will give you market price. What will they give you, beta? Market price. Now suppose I have already issued some old debentures at 100. And the market price of that particular debentures become 110 rupees. And I want to issue debenture. Will I issue at 100 rupees or at 110? 110. Why? Because already the ventures are traded in the market at 110. Clients, right now the market price is 1,500. So when they want to, will they issue at 1,000 rupees or will they issue at 2,500? Of course, it always is at market price. Can I conclude like this, that if the net proceeds amount is not available, they will sometimes give you what? Market. So once again, what's the formula for KD, everyone? What's the formula for KD? Can I say KD is interest into 1 minus tax upon net proceeds into 100. Will that give you your cost of debt? Come on, yes or no? Then the answer is yes. Then what about KP? Cost of, can I say cost of preference shares will be preference dividend? And is there any tax savings in the preference dividend? No. I will simply divide that by net proceeds. But both of this is only possible when the instruments are irredeemable. Life is. But do you practically this? Then there will be redeemable debentures. When there will be redeemable debentures, then don't you think my KD will be interest into 1 minus tax? It will be there. But with that plus, what do I have to do, beta? RV minus NP upon N. The whole upon RV plus NP upon 2. On this basis, on yes or no? Yes, sir. Okay. And also at the same time, when there is cost of preference shares which is redeemable in nature. So only difference will be instead of interest into 1 minus tax, what will be the next thing beta? Preference dividend plus RV minus NP upon N, the whole upon what? RV plus NP upon 2. Are you all okay with the first four? Of net proceeds, times they will always give you what? Market prices. Can I say we can replace the net proceeds by the market price of the investment given? Come on, yes or no? Yes, sir. Suppose I tell you that there is one debenture whose face value is and the market price of the debenture is 100. So then this new debenture will be issued at what beta? Will it be issued at 100 or it will be issued at 110? 110. And whenever you issue new debenture or whenever you issue, there is always some share issue, always some expenses which take into. This expenses is actually called as flotation cost. Have you heard about flotation cost beta? Flotation cost. So whenever there is flotation cost, suppose flotation cost is given to you as 10%, then we have to take 110 minus 10%. 10 minus what beta? 99. So net proceeds will be rupees. So they might give flotation cost or issue expenses or brokerage cost, something like that. Then will we subtract that as a percentage of the market price to get the net proceeds? Come on, yes or no? Yes, sir. Again, the face value of the debenture is rupees 100. We are issuing it at par. Can you please tell me what is the issue price beta? 100? On here, issue price is 100. But if suppose they are issued by some share issue expenses or the debenture issue expenses are 5%. So what is going to be the net proceeds, everyone? 95. Always apply percentage of float or issue or brokerage cost on the market price to ultimately get your net proceeds. Will you apply that on the redemption value? So these four formulas, redeemable and redeemable. What irredeemable and redeemable? Cost of debt can either be irredeemable, redeemable. Cost of preference can either be irredeemable or whenever there is redemption, always remember smaller formula or bigger formula, beta? Bigger formula. And when there is irredeemable, we will always use. But the challenging part is how do you calculate cost of. Now, cost of equity, now, my dear student, cost of equity. This is very dynamic because cost of equity is not necessarily calculated one approach. Cost of equity can be calculated by multiple approaches. And there are 5 approaches to calculate cost. Approaches are there, beta? 5. 5 approaches. The first approach there to calculate the cost of equity is dividend yield approach. The second approach to calculate cost of equity is called as earning yield. Then we have something which is called as dividend yield growth approach. It's actually called as Gordon's model. Have you heard about Gordon's model, beta? And then we have earning yield growth approach. Again, whenever there is the word growth, it's Gordon's model. And then we have the last approach, which is called as CAPM approach, capital asset pricing. But all these approaches, now, my dear student, they are based on only one object. And the objective is what? That here we first calculate what is the X. Always remember to calculate cost of equity. Expectations of equity shareholder. That actually becomes the cost for the company. Expectation becomes what, beta? Cost for. Let me explain. I am the company. You all are the equal. You have given me your, will you expect something? Give me money. I satisfied or dissatisfied? Dissatisfied by not the matter of the fact that I have not invited you, but dissatisfied from the perspective that, sir, we gave you the money and you have to grow that particular money, but you are doing party with that. So don't you think, my dear students, you will be satisfied? Come on, yes or no? Yes, sir. Always remember like this, that expectation of shareholder, that can be different from the perspective of the data which is. Now let's say, for example, for any particular company, suppose I tell you that the dividends grow, the dividends every year, let's say for example year 1, year 2, year 4, the dividends are same, constant. Now if suppose the share price is 100 rupees, what's the share price, my dear students? 100 rupees. What is the return, what is the yield which each shareholder, what is the dividend per share? 10. What is the market price of equity share, everyone? 100. So dividend is 10 rupees. Market price of an equity share is 100. Can you please tell me what is the return which you want from the company? 10%. How did you get this 10%? EPS by MPS into 100. So you took 10 upon 100 into 100, which gives you 10%. Solo yaar. So now when you are expecting 10% from me, you have given, should I earn or return less than 10? More than 10? I will try to earn your 100 rupees. I am or just 5 rupees. Satisfied? Dissatisfied? So what is your expectation? Your expectation from the company is 10%, and your expectation becomes my dash. It becomes my cost. So if you are expecting 10% from me, automatically, can I say that for me the cost of equity automatically becomes how much percent, beta? 10%. So KE, my dear student, always needs to calculate from expectation of equity. And that's why you will see the name of the approach, which is dividend yield returns. So if I know as a CFO of a company, how much are my shareholders expecting, can I say I will come to know automatically what is my cost of equity? Come on, yes or no? Yes, sir. So the best way to understand cost of equity, that first we should, what are the returns for equity? What are the returns which they are expecting? And the first approach which we have is which approach, beta? Dividend yield. What's the formula for dividend yield approach? Everyone please tell me dividend yield approach. What's the formula to calculate your KE? KE will be DPS by MPS into 100. But if suppose the company is not distributed, then we will have something which is called as your earnings yield approach. What will be the formula for earnings yield approach, beta? KE will be what? EPS upon MPS. Are you all okay with first two KE calculation? Come on, yes or no? Yes, sir. But do you think that the dividends of any particular company will perpetuate? In real life, do you think the dividend perpetuate? That's why came intelligent professor Myron, and he invented, told case, sir, we have to see what is the dividend yield growth approach. The formula with beta, dividend yield growth approach. And for this, you know what's the formula for KE? The formula for K is D1 upon P0, 100 plus. What is the formula, beta? D1 upon P0 into 100 upon P0 plus G. but then the answer will be in decimals. You have to multiply it by 100 to get the KE part. Up to you. But what's the formula for KE, everyone? D1 upon P0 into 100 plus G. What is D1 beta? Can I say D1 means dividend today or dividend at the end of year? Because if I'm investing in shares today, will I get last year dividend or will I get next year dividend? And if suppose there is growth which is given to you in the question, then what should be my next year dividend beta? Last year dividend plus growth rate. So what should be your D1 beta? I say D1 will be nothing but D0 plus. What is D1 beta? Bolo, tell me. D0 plus G. Last year's dividend plus the growth rate. Suppose the dividends for the last 3 years is 10, 11, 12.1. Are the dividends growing beta? Dividends are growing at what percentage rate? 10%. Here, Rahul, next year, if I want dividends, will I be satisfied at 12.1? Satisfied with less? Or will I get more than 12.1? So can I say in my expectation, I should take KE as 12.1 plus the growth rate of 10%. Come on, yaar. And this I will divide by the market price. Suppose market price is 100 rupees into 100 plus the growth rate of 10%. Will this define my company? Come on, yes or no? Yes, sir. So everyone, what's the formula for K? D1 upon P0 into 100 plus. That gives your KE. Come on, yes or no? Yes, sir. Now, can you please tell me what is your KE? 12.1 plus 10%. This will be 13. Upon 100, 200. So this is 13.31% plus 10% means this is not 14, this is 23.31%. 5% plus 2% is 7%, not 5.1. Hey yaar, hello. 10% plus 5% is 15%. It is not 10.5. 23% plus 2% will give you what? 25%. Of 20. Okay, are you guys trying to understand this? So whenever there is growth rate which is given to you in percentage terms, we will add it and final answer. Okay. So this is how can you calculate your KE using dividend yield growth approach. Come on, yes or no? Yes, sir. What do you think should be the formula for earning yield growth approach? Give me the formula. Can I say earning yield growth approach will be E1 upon P0 into 100 plus G. On yaar. 1 upon P0 plus G. What is E1 beta? Can I say this is earnings at the end of year 1? Of course, always ask you question on dividend yield growth approach, but because I'm revising everything, I'm considering all the approach. So what was the first approach, everyone? Dividend yield approach. Formula solo. DPS upon MPS. What is earning yield? EPS upon MPS into 100. What is dividend yield? D1 upon P0 into 100 plus G. And what is approach? E1 upon P0 into 100 plus G. Now growth rate is usually given to you. If growth rate is not given to you, then they will give past year data where the dividends are growing at a constant rate. So can we calculate the growth rate accordingly? Come on, yes or no? Yes, sir. Or else the growth rate can also be calculated by taking your retention ratio and multiplying that by ROE. On this basis also we can calculate the growth. You must have seen like this B. Okay, whatever is your retention, you have to multiply that with what? ROE. Will that give you your growth rate? Come on, yes or no? Yes, sir. So growth rate can also be defined by taking retention and multiplying that by ROE, or growth rate. Everyone, please tell me what is retention ratio, beta? 1 minus dividend payout ratio. ROE to anyway, equity shareholders. Are you all okay with this? All approaches? Come on, yes or no? Yes, sir. Now, sometimes, as I told you, this P0, can we replace it by net proceeds? No. Yes or no? Yes, sir. Because they will give you that the equity shares were issued at market price and there was 5% float. So can I say from the market price, will I subtract flotation cost or share issue expenses to calculate the net proceeds? Come on, yes or no? Yes, sir. Okay, so everywhere, whenever there is flotation cost given, you always subtract it from price to get something. Yes. Then, my dear students, there is something which is also called as capital asset pricing model. On this basis also, can you calculate the expectation of shareholders? Come on, yes or no? Yes, sir. Does anyone know what's the formula? RF plus RM minus RF into beta. That also on yes or no? Yes, sir. This RM minus RF actually called as market premium. Okay. RF is nothing but risk-free rate. Suppose they give you that the risk-free rate is 7%. They give you that the return on market is 10%. And they give you beta of 2. Is this data sufficient for you to calculate what can be your KE? Come on, yes or no? Yes, sir. How will you calculate KE beta? 7% plus 10% minus 7% in 10 minus 7 is 3. 3 into 2 and this is 7. 7 plus 6% will give you what beta? Yes or no? Are you all okay with this much part? I have taught you total 9. First I taught KD. Everyone formula KD. I into 1 minus tax upon net proceeds into 100. Then I taught you KP irredeemable formula. Preference dividend upon net proceeds into 100. Then I taught you KD redeemable. I into 1 minus tax plus RV minus NP upon N, the whole upon RV plus NP upon 2 into 100. Then I taught you KP redeemable. Instead of interest into 1 minus tax, I will just substitute PD plus everything else remains. Then to understand cost of equity, we understood that cost of equity, can I say, we always calculated from equity shareholders perspective. And whatever is equity shareholders perspective, that is nothing but the cost for the company. So how will you calculate your KE? For KE, we have dividend yield approach, earning yield approach, dividend yield growth approach, earning yield growth approach, CAPM. Everywhere. Because your expectation is my cost. Okay? Dividend yield approach formula solo. DPS by MPS 200. Earning yield approach EPS by MPS. DYGA D1 upon P0 into 100 plus G. E1 by P0 into 100 plus G. And CAPM is RF plus RM minus RF into beta. Everywhere if the flotation subtracted from called as net proceed. So this is how we calculate cost of. Then Rahul, there is something which is also called as weighted average cost. Does the company raise the finance one source or multiple sources? In same proportion or in different proportion? Of course in different. can I say that if I'm raising the funds from debenture, preference shares and equity, and I want to calculate the overall cost, what I have to do? First I have to take what is debenture. Suppose debenture is 10 lakh, preference share is 20 lakh, and equity share capital is, let's say for example, 70 lakh. What's the total amount from which I've raised? On everyone, what's the total amount? 1 crore. Don't you think I should take the weights of this? So debentures are forming, can I say 0.1, 10%. Preference shares are forming what? 0.2. Equity is forming what? 0.7. And then I have to calculate KD, KP, KE. If I take the weights and if I multiply that by the specific cost, can I say the total will be called as your weighted average cost? So what is weighted average cost? Capital beta, whatever is individual sources, we multiplied by weights and we take total. So this 1 crore, what is the weighted average cost of capital? Now, my dear student, there are three types of weights in types of weights are there, beta. Three types of weight. Something which is called as your book value weight. Then it is called as your market value weight. And then it is called as marginal value weight. You heard about this? What is book value weight? Book value weights are also known as your balance sheet value weights. What are they known as? Balance sheet. That I have to take directly the figures from the balance sheet. So I will have to take the figures directly from the balance sheet. I'll be having equity shares, I'll be having preference shares, I'll be having debentures, reserves and surplus, long-term loans. Will I take each and every source? Come on, yes or no? Yes. And everything from the balance sheet needs to be taken into consideration. Then, my dear, once I have sources of funds, I will write down its, then I will write down its weights, and then can I say I'll be taking cost of capital, I'll be multiplying that. Will I be getting weighted average cost of capital? Come on, yes or no? Yes, sir. My simple question to you is, in book value weight, should you also consider reserves and surplus? Yes or no? Yes, sir. Reserves is also part of us. You have to also take reserves and surplus. But what is the cost of reserves and surplus? Do you have any specific cost? Whatever is your cost of equity, that itself will be your cost of reserves and surplus. So can I say KR should be equal to what? KE. Because reserves and surplus belongs to whom, beta? It belongs to equity shareholder. Where is your KR? That should be equal to your KE. But the only exception here which you have to remember that flotation cost, what did I just use the word? Flotation cost should be ignored in calculation of KR. Because flotation cost are share issue expenses. Will that flotation cost come in calculation of KR? Then the answer is no. Because we never have flotation cost from the KR perspective. We have it from the KE perspective, yes or no? Now, what is market value weight? Can I say when I talk about market value weight, I will have to take each and every and write down its market value. Equity shares market prices are readily available. Debt, if it is listed, their market prices will also be available. Preference shares, if it is listed, that market prices will. Do you think will there be any market value for long-term loan? Then the answer is no. If I have taken loan from HDFC Bank amount 20 lakh, does it have any market value? Will it have any market? Then the answer is absolutely that will not have any market value, because debt taken from the bank, it does not have any market value. So for that, book value itself is market. For equity shares, preference shares, debt, etc. Can they give the market prices available? Come on, yes or no? Yes, sir. In the amount part, write down book value, or in the amount value down. Okay. Then what are marginal value weights? Marginal value weights are always additional value. What are they called as, beta? Tell me. Additional. Matlab, there is nothing regarding your existing capital structure, whatever you how much new funds you are raising, you have to take that into, and at what weights you are raising funds, that should be. And once we take that new weights into consideration, that new weights, we will have to multiply that by the effective cost. So weighted average cost of capital has how many types, beta? 3 types. First one is what? Tell me. Book value weight. Second one is what? Market value weight. Third one is what? Marginal. And you know what? Whether it is book value or market value, the cost which we calculate, is it going to remain the same? The specific cost which we calculate, the KD which, will it remain the same in book value weights as well as in market value weights? Yes or no? Yes, sir. KP, whatever we calculate, that will remain. The only difference is the valuation of weights. Which, now see, if I come to this question, I will solve one question which has all the things together. That is, you are required to calculate book value weights as well as market value. What is the capital structure given to you? So existing, there are 5 lakh debentures, 5 lakh preferences, 10 lakh equity. Total is what, beta? 20 lakhs. Are we having market price of debenture, preferences and equity shares? Come on, yes or no? Yes, sir. Then they have told you that rupees 100 per debenture redeemable. Redeemable means smaller formula or bigger formula, beta? Bigger formula will be available with 10% coupon rate, 4% flotation cost and 10-year. Same with preferences, these are also redeemable. And then equity shares of flotation cost of 4 rupees and the market prices of 24. So what is going to be the net proceeds in this particular case? 20 rupees. Right? Because 4 rupees is flotation cost, 24 is the market. The net proceeds will be your study module. The next year expected dividend is rupee 1. The next year expected dividend what is given? What does it mean? Does it mean D0 or does it mean D1? So do we have your D1 readily available? On yes or no? Yes, sir. Do we have the growth rate also available? Come on, yes or no? Yes, sir. And the firm has the practice of paying all the tax, 30%. We are required. The first step always is to prepare a table. Okay. Now first, if I write down calculation of WACC using book value weights, using what as weights, beta? Book value weight. And then I will again prepare a table in which I will write down calculation of WACC using what as weights, beta? Using market value weights. Just understand the solution. So first I will write down what are my sources of funds. Then I will write down what is going to be my amount. Then I will write down what is going to be my weights. Then I will multiply that by my after tax cost of capital and ultimately I will be getting my weighted average. So there is going to be sources, there is going to be amount, there is going to be weights, there is going to be same columns, after tax cost of capital, and the last one is your weighted average. Can you please tell me in your book value weights, what are the types of instruments? 3 types of instruments. What are the 3 types of instruments, beta? Debentures, preference shares, equity shares. So here also there will be 3 parts, beta. Debentures, preference shares. Now what is the amount which, can I say for debentures this is 5 lakhs, 5 lakhs, 10 lakhs. Give me the total. 20 lakhs. So total amount is. And what is going to be the weights? 5 lakh divided by 20 lakhs. Tell me 5 lakh divided by 20 lakhs will be what, beta? 0.25. It will also be 0.5. Have I already calculated the weights? Yes, sir. In market value, should I write down the same 5 lakh, 10 lakh? Or should I write down the market prices? Do I have the market prices of debenture? Tolu yaar, how much is that? 105. Now what are the number of debentures? 5 lakh divided by 100, 5,000 debentures. And what's the market price? 105. Can you now give me, everyone, what is the market value of debentures? 5 lakh 20. Come on yaar. What is the market price of preference share? 110. Can you give me 5,000 multiplied by 110? How much is this going to be, beta? 5,50,000. And for equity, there are 1 lakh shares and the market price is what, beta? 24. So we should always write down the market values, that is 24. Is this sufficient to get what is going to be your total amount and getting weights? Come on, yes or no? Yes, sir. This will be 5,25,000 plus 5,50,000 plus 24 lakhs. The total should be coming as 34,75,000. Now, can I calculate the weights of the same? Come on, yes or no? Yes, sir. What is going to be the weights? 5,25,000 divided by this. 0.15. 5,50,000 divided by this will give you 0.16. And the total should always be 1. So I will take this 0. Have I got the weights also? Yes or no? Yes. I should try and calculate the cost. How will you calculate KD? Smaller formula or bigger formula? Formula solo. Interest plus upon N. Come on, yaar. Tell me, do you have any, talking about the question, do you have any interest? What is the coupon? Coupon means interest rate. 10%. 10% on the face value of 100. Will I get the interest amount? Come on, yaar. So 100 face value multiplied by 10%. We're getting 10. What's the tax rate? Tax rate 30%. What is the redemption value? Can I say redemption will be at 100? What is the net proceeds? Net proceeds. Can I say net proceeds means market price? Market price is 105. Should I only take market price, beta? What is the flotation cost? 4%. 105 minus 100 point. What is the life? Life is 10 years. And can I say this I will divide by 100 plus by 2. Sufficient to calculate your KD on yes or no? Yes, sir. 100 minus 100.8. Divide that by 10 will give you negative 0.08, right? And this is 10.7. The final will be 6.92, which I have to divide by 100 plus 100 point divide by 2. That's nothing but 100 into 100. Coming as 6 point. So whether it is book value weights or whether it is market value weights, do I already have 6%? Well, come on, yes or no? Yes, sir. Perfect. I'm giving you 2 minutes time. Calculate KP. Give me KP. Though you all are tired, but you have to give me KP. Give me KP. Once you are ready with the KP, then I've received. You are ready? 4.0, that's the second. 4.0. What is your KP? Can I say KP preference dividend. What's your preference dividend, guys? 100 rupees, and the rate is what? 5%. 5 plus RV is 100 minus what's your net proceeds? Can I say it is 110 minus 2% flotation cost? Come on, yaar. 110 minus 2%. How much is this coming as? 107.8. What's the life? The life is 10 years. And I will divide this with what, beta? 100 plus 107.8 upon 2. What's your KP going to be? 100 minus 107.8 divided by 10. And this is going to be 5. The numerator will be 4.22. This will be 100 plus 107.8 divided by 2. This is going to be 103.9, which I need to multiply by 100. So 4.2, divide that by this into 100 will now give you 4.06. Have you all got 4.06%? It's very simple. Redemption is at par. And net proceeds is my same concept. Market price minus flotation. That be 4.06%, guys. Hello. What about equity? KE calculation. Can I say for KE, I am going to use dividend yield growth approach. Formula for KE. D1 upon net proceeds 200 plus G. They have already used the word expected dividend. Whenever they use the word expected dividend or next year dividend or proposed dividend, do I have to add any growth rate to that dividend, or that is already D1? Already D1. What's your D1, beta? 1. What is your net proceeds? Can I say market price minus flotation cost? Okay, so market price minus flotation cost. So market price is 24, flotation cost is 4. So will this become 20? Come on, yes or no? Yes. And then they have told you that the growth rate is 5%. This is 1 divided by 20 into 100 is 5% plus 5% will give you 10%. Don't forget this. Your KE going to be 10%. Come on, yes or no? Yes. Then I will calculate here 10%. And then can I calculate my KO? Come on, yes or no? Yes, sir. This multiplied by this multiplied by this multiplied by this, and then adding everything. Will that give you your overall cost? Okay? I don't want the answer, but I hope you all have understood this. So again, a comprehensive question which covers what? Book value weights, market value weights, and in the formulas also we took the bigger formula, that was your redemption wala formula. Okay? Are you all clear? Okay. Yes? Doubts, Rahul? No? Now, we will solve one question on the basis of marginal value weight. Book value weights will also be done, marginal value weights will also be done, and market value weights. For that, there is a very interesting question which is also there in your study module with regards to this question number 10. Okay? Do it, beta. Problem. Let us start with this question. Now see what is given to you. ABC has the following structure which is considered to be optimum. Optimum means, can I say this is the best capital structure? Right? This is the best capital structure. If the company is going to raise any further funds, will they raise it on the basis of their optimum capital structure only? Come on, yes or no? Yes, sir. Always remember like that. Whenever they give you optimum capital structure means the capital structure which the company will follow in future. What is this capital structure they have given to you? That includes debt, preferences, equity. What is the total amount, guys? 2 lakhs. Can you please give me the weights of debt? 30,000 divided by 2 lakhs. Can I say debt is 15% or 0.15? Come on, yes or no? Yes, sir. 10,000 divided by 2 lakh is 0.05. And 1 lakh 60 divided by 2 lakh will be 0.8. Because obviously the total should be 1. So any extra amount which will be raised, will it be raised on the basis of the optimum capital structure? Come on, yes or no? Yes, sir. Of optimum capital structure. The company share has a market price of rupees 23.6. Next year dividend is 50% of 2017 EPS. Guys, next year dividend. Next year dividend means D0 or D1. So they have told you whatever is 2017 EPS, you have to multiply that by 50%. That will give the dividend for the next year. Hey, Gauni. Then the following is the trend of the EPS for the preceding 10 years, which is. Can you all just check that there are 10 years EPS given to you? Come on, yes or no? Yes, sir. Look at it and roughly tell me what. 10%. Yes, Alvar? 1.1. So that's 10%. So also 10%. And so on. What is the growth rate, beta? 10%. Then the company new debentures carrying 16% rate of interest and the current market price is 96. Preference share is 9.2 with annual dividend of 1.1 which are also issued. And the company is in 50% tax bracket. You are required to calculate what is the cost of new debt, cost of new preference share, equity. Okay, first of all, how will you calculate your cost of new debt? Guys, are the debentures redeemable or the debentures are have they given you life? Have they given you life? No, there is no life. Life left also, I know that. Okay. But is there any life or there is no life, beta? Okay, no life. So smaller formula or bigger formula? Smaller formula, everyone, formula solo. Interest into 1 minus tax upon net proceeds into 100. Hey, everyone, please tell me what is the face value of the debenture? Can I say the face value of the debenture? There is no information. But when we are issuing debenture at 96, what does it mean that the face value is dash 100? What's the coupon rate? So can I say 16 rupees is your interest? Tax is given to you solo, yes or no? 50% is the tax rate, 0.5. And what is the net proceeds? I told you that the net proceeds can be reflected by taking market price. Do you have market price? Come on, yes or no? Yes, sir. Can you give me what is the answer? 8 divided by 90. Can I say my cost of debt is 8? I was the market price. Yes or no? Yes. Everyone is okay with this? What about formula for KP? Can I say that will be PD upon net proceeds 200? Everyone, what is the annual dividend? 1.1. And we are issuing the new preferences at what price? 9. There will be tax savings or no tax? 1.1 divided by 9.2. What is this? 11.9. Right? I taught you redeemable. Now I am teaching market price with net. That's it. Okay. Then they have told you what is cost of new equity, but they have told you consuming new equity is from retained earnings. Matlab you are required to calculate KE or required to calculate KR. KR. Now please tell me, was there any growth rate which was given to you? Come on, yes or no? If the growth rate was given to you, which approach will I use? Dividend yield approach or dividend yield growth approach? Dividend yield growth approach formula solu. D1 upon P0 into 100 plus G. Hey, do I have the D1 available in the question? It is next year's dividend they have told you. See, next year dividend is 2017's EPS. See, they have told you that next year dividend is 50% of 2017 EPS. What is 2017 EPS? 2.36. So what is going to be your next year dividend? 2.36 into 50%, that is 1.18. And everyone please answer this in one voice. Will I add any growth rate to this? Amma ille. Amma ille. Why ille? Because this is already your next year dividend. Purinjida. Students make maximum mistake here. They take 1.18 plus. Whenever you next year, there is proposed, and then there is, D1 etc. directly given me. This I have to divide by the market price per share. Do I have the market price of the share? Do I have the market price per share? Yes. The company has the market price per share of 23.6. Divide that by 23.6 plus growth rate. You only told me 1.18. Divide that by 23.6. 100 plus 10. How much is this coming? First part clear, beta. First part clear, yaar. Then calculate marginal cost of capital when no. Now we are required to calculate marginal cost of capital. Guys, for marginal cost of capital, we should have sources, we should have amount, we should have weights, we should have after tax COC, we should have WACC. Everyone in one voice. Have they given you weights like marginal value weights at what weight? They given you specific information, AMA or ILE. But optimum is given. Which mum, beta? Are which mum? Have they given to you optimum capital structure? Come on, yes or no? Yes, sir. Optimum means, can I say in this particular question, already the weights are defined. Weights are defined. So do I need further weights? No. Weights are defined. Can I say there is debt, preference shares and equity? But instead of equity, can I say there can be something which is also called as your reserves and surplus? Chalo yaar. Okay. I don't have the amount, but it's okay. I don't need also. I have the weights available. Everyone in one voice, what are the weights, beta? Can I say your debt weight is 0.15, 0.05 and 0.8, total should be 1. What about the cost? We just now calculated the cost. Don't look at the question. We have just now calculated the cost. What is the KD, guys? 8.33. What is the KP, guys? 11.96. What is the KR, guys? 15%. Because they have told you without issuing retained earnings. Will I be getting my KO? Can I get my KO? So yes, sir, you have to calculate. 7. This point. The total is 13 point. Yes or no? Yes. Marginal. Are you all okay with the second part of the question? Come on, yaar. You coming as 13.8. What is the third part? How much can be spent for capital investment for new ordinary shares? Ordinary matlab equity share. Ordinary shares are sold. How much can we that retail? Now, out of this sources, even if I have one source available, then I can get the total amount. I'll tell you how. Suppose the company has debt and equity capital. Okay. Suppose I capacities. Pay attention. Can I say suppose debt is 20%, equity is. If I give you debt amount as 2, can we get the total amount of on yes or no? Yes. How will you calculate? Take 2 lakh and divide that by 0.2. What is 2 lakh divided by 0.2? Everyone. 10 lakhs. So can I say from this 10 lakhs, 20% is debt and 80%? Cholu yaar. If I have one. Tell me one. Have retained earnings. Yes. They have told you that it is but 50% of your EPS. Divya, they have told you 50% of the EPS is your retained earnings. What is your EPS? It is here. What is your EPS? What is your EPS? How much is 1.18? 1.18 is per share. What are the number of shares? People are saying 1 lakh. Arey 1 lakh, where is it 1 lakh? Can I say it is 10,000 shares, yaar? है ना? So yeah, I know, but wait. Can I say your EPS is nothing but rupees 2.36, guys? How much are we retaining? 50%. So are we retaining 1.18? And what are the number of shares, beta? 10,000. What is my reserves and surplus? 11,000 is my reserves. Do I have the amount? Yes or no? Yes. And do I have its weights also? Well, yes or no? Yes, sir. Can I get the total amount? Yes or no? Yes, sir. 11,800 divided by 0.8. 14,750. Everyone in one voice, what is the total amount we can raise without issue of new shares? Come on, yes or no? Yes. If I have one source amount, the total amount now, that is 4. Tell me if I have more than 4, do I have to issue shares? Come on, yes or no? Of course, yes. Can everyone please tell me for issue equity shares for have they given to you in the question the D part? What is the marginal cost when the funds exceed, assuming the new equity will be issued at rupees 20? Now, are we issuing equity shares? Come on, yes or no? Yes. But what is the net proceeds of the new 20 rupees? So will my KR change to now KE? Come on, yes or no? Yes, sir. But now again I will have to prepare a table where I have to calculate overall cost. That will be sources, amount, weights, POC, WACs. Can you give me the sources? Debentures, preference shares, equity. Now I will not write down reserves and surplus. Write down equity. Are my weights defined? Yes or no? Yes. What are my weights? 0.15, 0.5 and 8. Total should be. Do I already have cost of debt? Yes or no? Yes. Which was 8.3. 11 point. Calculate my KE. What is the formula? 1 upon net proceeds plus G. Are we issuing shares at 20 rupees? Yes or no? Yes. This is how we calculate. Capital has how many? 3 types. Book value, market value, third, marginal. Now, but just one last adjustment. Because if I only kept it for concept now, passing bottles also there. Deliberately to. So now we'll be starting with one last concept because this was last attempts, 4 attempts ago, about how the growth rate when directly they have given amount since at the 5th year and amount today. Then we have to use one formula on the basis of compound interest. And actually, what happened? That that paper they had given you that growth rate table, but I will teach the table is not given to you. Okay, fine. Online students, you guys are there with me. Online students, you guys are there. Come on. They are sitting in front. I hope. Kavi Chitra has written after of time. They're sitting a little bit far. Are you there with me? Yes. Guys, Last question. Thank you. Get up. Hey. Now, here also we calculate the book value weights and market value. Ish, tell me, do you have book value, retained earnings, preference, ventures on yes or no? Yes, sir. Market value weights, you can. Is there any retained earnings, market value weights? No. But I told you that when not equal to KR, at that time I have to consider market value. Can you all please tell me what is the market value of equity? 2 crores. But in this question, your KE and KR are not the same. In that particular case, I have to write down market value of risk. I don't have market value of, but I have market value of equity available. Do I have market value of equity available? It's there in front of you. How much is that beta? 2 crores. I have to divide this in book value weight. So this 2 crores, if I divide it into book value weights, so 2 crore divided by 1.5 into 1.2. Can I say 1 crore 60 lakhs and 40 lakhs is your reserves? And now how did I come to know KE? Not this. Pay attention. Can you all see? Equity shares are quoted at rupees 130 and the new equity priced at 125 and the flotation cost is. I consider your KE, yes, but in KR, no. So for calculation of KR, will I take the market price of 130 only? Come on, yes or no? Yes, sir. But for calculation of KE, can I say from 125, 5 rupees will be subtracted. So what will be my net proceeds beta? 120 rupees. How do you calculate KR? Everyone, formula. P1 upon P0 into 100 plus G. How do you calculate KE beta? P1 upon net proceeds into 100 plus. Is there a difference KR and KE? Yes or no? Yes, sir. Because of the presence of the flotation cost. Will I consider flotation cost in calculation of KE? Yes, sir. So market price was 130, but we were issuing it at 125. And then again, there is a 5 rupees flotation cost. So ultimately, I am going to receive 120 only. But for KR, we don't do all this natak. I say we only take into 130 and. Okay, are you guys trying to understand this? Okay. Now, please tell me, how will you calculate? Listen to this. During the previous 5 years, dividends have been steadily increased from 10.6 to 14.1. Dividends have been increased from year 1, 2, 3, 4, 5 from 10.6 to 14.19. Have they given you at what rate? Have they given you at what rate? They have not given. Growth rate will be, can I say, amount is equal to principal into 1 plus I raised to the power n. Are you aware about this? What is the amount? 14.19. What is the principal? 10.6. 1 plus I raised to the 14.19 divided by 10.6. Can you all please tell me what is this? 1.3387. This should be equal to 1 plus I raised to the power 5. So now I have to calculate the fifth root. Okay. Now in examination, always give that this is at 6% growth rate. They will always give you this figure. But if they don't give it to you, then what should you? Now we have to calculate the fifth root and calculate this on our normal calculation. Alvar, tell me Alvar, what will be your first? Acha, you did trial and error. I'm not telling you to do trial and error. 12 times, root 12 times minus 1. Divide by the number of root plus 1. That's what we have to do it. Into is equal to. Are you aware about it? First type the number which you want to take the fifth. You want to take 1. 3387. Then what will you do? Press the square root sign 12 times. So you'll not, little bit we have to adjust. You take 15 times, get exactly. Chalo, let's do it for 15. Okay, let's do it for 15 times. 1, you have to press square root time 15 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. You done that? Now what will you do? You have to do minus 1. Take minus 1. Then you have to divide by 5. Then you have to take plus 1. Then you have to take into is equal to 15 times. Into equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Are you all getting 1.060075018 on your calculation? Then you subtract minus 1. You will be getting 0.06, also called as your. If you do it by 12%, now you'll get 1.06001, something like that. Okay, nearest to that. By 50, do it by 12 times anything. And on that basis, can we get the growth rate of 6%? Come on, yes or no? Yes, sir. I'll write down the steps here. How do we do it? Step 1. Some people just lost in between. What just happened? My calci has never been used so much. Okay? For exploitation of use of calcium. What is this number, beta? 1.3387. First, you have to type this. Then your step 2 is square root 15 times. Then it is minus 1. Divide by 5. Because it's fifth root. If it had been third root, you have to divide by 3. Don't do it because it is raised to 4. Because raised to 4, you can directly press square root 2 times and you can do it. Or else then there also you are doing for 15 times. Don't do it that. This dirty power only we have to do it like this. Power, dirty power, like 5, 7, 3. Then plus 1. Then multiplied is equal to 15. Then we will subtract 1 divided by 100 will be. Purinjida. Wait. Okay. Are you all okay with this much part? We have got the growth rate. Now, all my intelligent students who are there on Zoom, I'm so proud of you. Last part, this part. This is a different, all different adjustments I'm doing. It's also a different. What is this? Company has started proposing now to issue 11-year 15% debentures, but the yield on the debentures with similar maturity and risk class is 60. Cost is 2. Now, how do you calculate the cost of such kind of information? Guys, what's the formula for KD, everyone? Interest into net proceeds. Watch. What percent? Everyone, please tell me, are we paying interest of 50? What's the tax? Tax rate is 35%. What is the net proceeds? Net proceeds means by the company. Everyone in one voice, please tell me, the similar debentures are yielding a risk class of 6. There is RIL, there is. Now, RIL is issued face value 100, coupon rate is 6. I am issuing face value 100, coupon rate is 50. You would, the very first instance, buy debenture RIL or RIL, na? Why? Because RIL is offering you higher. I'm like, wait. Suppose I issue this venture at a discount, such a way that whether you invest here or whether you invest here, you will be getting 16 only. Like to invest in a company, come on, yes or no? Yes. Now I'm telling you, I want to issue at discount. Now tell me one thing, for 100 rupees, the yield offered is, but now if I want 15, okay, now 1 second, no, don't do cross multiply. If I want what should my issue price, then can I say I will have to issue at more than 100 or less than 100? Of course, less than 100, na yaar. Because on 100, can I say 16 is something which is offered by my competitors? Come on, yes or no? Yes. I am just willing to give 15 rupees dividend. Then I should issue this debentures at par, premium or discount? Discount. So now if I cross multiply, then can I say the answer is coming is 93.75. Now I am telling you that you 100 rupees, you are going to get 60. But if you want to invest in my company, I will issue the debentures at 93.7. That 93.75 means that at discount only I am offering it to you. So whether you purchase the debentures of RIL or BIL, don't you think that the yield which you are going to get will be dash? It will be same. Are you understanding? That is why when such kind of data is given to you, then we do getting 9.75, but there is 2% of face value. 2 rupees is the flotation cost. Net proceeds will be, that's how I'll be getting. That adjustment, was there any 2% flotation cost also? Come on, yes or no? That adjustment, was there any 2% flotation cost? Come on, yes or no? Yes. And that 2% is on face value. So what's the face value? The face value is 100. So how much flotation cost I have to pay? 2 rupees. Don't you think my net proceeds will now become what, beta? 93.75 minus 2. And that will give. Now with this I can say I have comprehended. I have not left. Come what may now. With this, my dear students, again, cost of capital chapter. Oh, thank you. You don't clap, okay? Are we done with, are we now? Are we done with first? Eight. One bonus, yaar. Debt service cover. It was leverages. By the way, in ratio, called many, where we had to prepare the entire P&L balance sheet. Did that work cost, and we did all the study module also. Leverages. Also, we solved many questions. Did concept of OL, FL, CL, static formulas, dynamic formulas. Also OL, MOS calculation also PV ratio questions also. We did all these things. Then we started with capital structure. In that also we did 3 types of questions. Selection of a plan, indifference point, financial break-even point. Then I also explained you the relationship. Relationship of what and what? Indifference point and financial break-even point. On yaar. Then we also did cost of capital, in which I taught you 9 formulas. Specific cost, 9 formulas. KD irredeemable, KD redeemable, KP redeemable, KP redeemable, KE has how many approaches? 5. We discussed that. They're on dividend yield growth approach. Did questions on dividend. And in WSCC, how many types are there? 3 types. book value, market value, marginal value. We did questions on book value, market value both, and we also did marginal value. And this different adjustment also. Of course, there is realized yield forming part in my next series. That is, can you see here? I have actually mentioned cost of capital 2. Cost of capital 2. Cost of capital should only be done after your investment, because there is concept of IRR which is there beta IRR. Here we are required to use YTM method. That also I'll be covering. If you open the study module today and you will see, where is realized yield approach and where is YTM? So this covered later. Now we are left with capital structure theories. Capital structure theories we have to solve. Okay. Now capital structure theories we'll be doing this tomorrow. Then we'll be investment, then cost of capital. And after the lunch, working capital management. Cash budget will only take 50. Dividend decision, explain you the which approach when. I'll do one question for, and that's it. That way. So what is the time? 1 second. Arjun has asked me a doubt whether float I always be on market price until question that there I will upload this by tonight. From there via app at base. Can this now are you all iOS and once the app now you would F A that hello yaar app will be downloaded on your there now load this question as a solution set today. What is the name of Demi? That basis this tomorrow 9 comfortable 9 a.m. time 9 o'clock okay. Got it? That's it. I hope you all have enjoyed what we have done. So, all understood everything. Tomorrow I'll see you. That's it.